The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the charts, let's have a quick look at what traders are watching. US Deputy Secretary of State Christopher Landau speaking to China's Vice Foreign Minister, and the pair agreeing on the importance of keeping open lines of communication. Meanwhile, US President Trump's administration has revoked Harvard University's ability to enrol international students and is forcing current foreign students to transfer to other schools or lose their legal status. Japan's core consumer inflation hit 3.5% in April to advance at its fastest annual pace in more than 2 years, maintaining pressure on the central bank to continue raising interest rates. And Russia says it has shot down 159 Ukrainian drones over Russian regions as the war in the area heats up, despite major powers discussing ways to end Europe's deadliest conflict since World War II. Let's get across the technicals. Chris Weston from Pepperstone joining me. A lot of movement in the bond market, Chris, on this big, beautiful bill.
Yeah, I mean, I think the Moody's downgrade on Friday really just reinforced what everyone knew, but it just brought the idea about fiscal deficits back into the picture. They've passed this fiscal bill, the budget negotiations through the House. I mean, it took a bit of working, but they've done that now, and I think that the idea about people trying to model the numbers and understand what this means for future deficits, future interest payments, future supply, coupon issuance going forward. Obviously, that's a big issue. And I think this what we've seen going through the House is probably modestly stimulatory and increases deficits a little bit. But I think probably let's see what happens when it gets reworked through the Senate. They're going to be talking about reducing the cutbacks in Medicaid and various factors. And then obviously the tariff situation in terms of how much revenue they're going to be collecting. If it, in its current form, it does still raise a decent amount of revenue, but we're not 100% sure exactly how that's going to go, if it continues to go at those levels or it sort of gets reworked to about 15% in terms of the effective rate going forward. But what we've really been seeing here, if you bring up a chart of the 10-year, I think I sent you a chart of the 10-year Treasury. As you can see, the top pane is the 10-year Treasury. We got above 460 yesterday, into 460, which was those previous highs. We've rolled back a bit today. I mean, in the session overnight, we did see a few bond buyers playing through at the long end. And really what we've got to keep our eye on at the moment is this concept called term premium. Now, term premium essentially is the compensation that bond investors want for lending the government money for 10 years, as opposed to just simply going out and buying a 1 year, 12-month bill and then just rolling it over every year for 10 years over maturity. Why wouldn't you just do that when I can, or I can buy a 10-year? Now, you're going to have to compensate me for the risk of liquidity risk, inflation risk, growth risk, all those factors. And that small segment plays is what we call term premium. Now, that term premium you can see on the bottom pane has gone up to about 91 basis points, which is the highest level since 2014. So that is showing us that bond investors are saying to the government, if we're going to lend you money for 10 years, then you're going to have to compensate us for that inflation risk. And the higher it is, the more the perceived risk. And that does not fit well with equity investors. And that's what we've seen now. The rate of change is moving up higher. And that is impacting the long end of the curve. It's why we've got the 30-year Treasury trading north of 5% at the moment. And we've got the 10-year at these levels at the moment, pushing through recent high yields. Now, that I think the equity market can easily absorb higher yields if it's driven by better growth dynamics, because obviously then you get earnings per share growth and various factors. If it's driven by inflation expectations moving up and term premium, which is obviously what we're going to see, that's a whole different factor, because you've got the right tail risks of higher inflation, term premium, but we're not getting necessarily the growth. In fact, we think that the second half we're going to see a marked step down in growth dynamics in the US, as a lot of these a lot of the growth has been brought forward to the recent period. So this is a really big concern, because obviously you've got a high discount rate, you get lower net present value on those duration assets, but it's driven by negative factors, this term premium, and term premium itself is a difficult one to concept. A lot of people don't really fully understand it. In fact, people in the bond market don't really, or they would understand it, but they'll give you different answers for what it means every single time. But the fact is that the back end of the curve is being driven up by term premium, which is not good for growth. It's why the US dollar's falling when we get bond yields moving up. And this is a dynamic that we're going to have to look out for next week, because they're going to try and push this bill through the Senate before recess. And we've got a number of bond auctions next week, and we want to have a look at the demand for the 2s, 5s and 7-year bond auctions. If we don't see very good bid covers, if we see it tail, you could see high yields playing through. And again, that could be one of the biggest drivers for next week. So, we were expecting deficits, and this idea about bigger coupon issuance and supply coming into the market to weigh on the long end, probably not till July. But I think what the Moody's downgrade has done is it's sort of accelerated and brought that forward. So this is really the big focal point at the moment is high yields. You're going to get a lower US dollar. You're going to see lower equity markets, and gold and Bitcoin working quite nicely as a hedge against that rise in term premium. So this is the big factor now.
All right, Chris, what does it all mean then for the S&P 500?
Well, if you have a look at the daily chart of the S&P 500, one of the interesting things after a 24% rally from those early April lows, a lot of that was short covering. But what we've seen is a wedge pattern. So really, what we're trying to do is look at reoccurring behaviours in the market, and that's really what technical analysis is for me. It's just trying to have a look at the aggregation of flows and supply and demand, and trying to make sense of what it means and where the probabilities lie for future directions. Now, when you get that move up and you're seeing the ranges contracting, it's showing that the market is a bit tired, a bit fatigued, and then when it breaks down, traditionally that can be quite a good reversal pattern. But we're now holding support. And we're waiting potentially to see if some of this move gets unwound. People are still calling it a bear market rally. I think it's probably the biggest bear market rally the S&P's ever seen. But one thing we are watching now as we go into next week, obviously we've got Memorial Day on Monday, so we are seeing lighter volumes. We'll see that through tonight. People will take shut up shop. Is what happens here. And again, it comes back to my last chart. If we were to see term premiums rising through 1%, 100 basis points, and the long end really kicking further higher through those 460 highs I talked about, then I think what we do is we go through their support levels, we go through the 200-day moving average, which isn't actually marked on this chart, and we come back down to that black horizontal line which I've got there, which is really the gap low that we got from the 9th of April. And I think that's probably where we'd be looking for people, this saying buy the dip. That would probably be the level that we'd be looking for price to come down to, and then obviously see how it supports around there. But the market has a really clear reversal sign here. It's broken out. It now needs to kick through that orange support level. But really what we're doing here is just trying to aggregate all the flows, the behaviours, the belief systems in there, trying to remove all the sort of noise that's going in, and price is the only opinion that matters in that situation. So break the orange line. I think we go down and fill the gap there, and this is a really pretty powerful reversal signal.
All right, what about Bitcoin? It's going ballistic, new record highs.
Oh, I mean, for me, this Bitcoin and gold are very similar in this situation, which it's just, again, it's an aggregation of all the flows. You don't really need to know the fundamentals about this. What is the blockchain doing? All this, the ETF inflows that are coming through, and the ETF inflows in the US and the BTC inflows have been very, very strong last 7 or 8 days, and that's been a really good predictor or correlation with returns that you see in Bitcoin. But for me, I think this is one about the art of holding, and you can see this now. It trades. Bitcoin's just trading absolutely beautifully on the technicals, because you get a nice impulsive move up, it consolidates, it bangs across the ceiling, and then we get a big powerful breakout and it closes pretty close to the highs. It's exactly what you want to see in a high momentum, high trending market, and that's exactly what we're seeing now. We've got that breakout. Price is just going down into those short term. I've got a black line there, which is the 8-day exponential moving average. And when you're seeing these markets moving up, they come down, they're defined by these moving averages, and that's been a really good way of having a systematic stop. So you only get out when the market goes below that level and closes on a daily basis. That keeps you in the trade even when it doesn't feel like it's right to be long. And right now, we're long and strong. It's all-time highs. You can't really get any more bullish than that. And I couldn't tell you how far this goes. I don't really care. The market will tell me when to get out. So for me, no, well, that's right. I mean, the thing with a lot of traders, There's a saying in trading, you can't go broke taking profits. Well, you absolutely can. It's one of the worst sayings that's ever been made in markets because it implies that you have to be right every single time. And we're not right every single time. We're wrong quite a lot. And what that means is you have to hold your winners and you've got to try and get as much juice out of them, and you've got to cut losses really quickly. And that gives you a skew in the distribution. So the art of holding winners is actually one of the hardest things that a lot of people do. So you're in a winning position, market looks like it's going to roll over, and you cut it because you're like, I don't want to be wrong. Humans are told we have to be right all the time. So the art of holding winning trades for a lot of people is where you're going to actually make your money and actually have consistent profits. So that's everything everyone needs to work on, and being unemotional is really important in that art.
All right, always unemotional, focusing on the trade. Chris, have a great weekend. Chris Weston from Pepperstone. That does it for this edition of The Trade. Be sure to join us again on Monday.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.